Welcome back to my channel, Tips to Financial Independence. I hope you're enjoying the content in the channel. Please remember to like, share, and subscribe. I would also love to read your comments. Today, I'm going to talk about the 2022 stock market. The market is red. Your stocks are losing value. The market has been bleeding red since January 2nd. Very few people invested in the stock market can say their portfolio has not decreased in value this year. The S&P 500 has fallen 10%. Remember, the S&P 500 benchmarks the US stock market performance. If your portfolio has fallen about the same percentage as the S&P 500, at least you know that you're not alone. I'll stress this point. These are only paper losses. The losses become real if you decide to sell your stocks for fear of losing more money. Why is the stock market red? Some say it's because of inflation. Some say it's because Russia wants to invade Ukraine. Some investors may have only experienced a bull market, especially the last 3 years, whereby the S&P 500 had an annual return of over 31% in 2019, 18% in 2020, and 28% in 2021. Do not make a rookie mistake. People who have invested in the stock market in the past 20 years will tell you through experience that the market always rebounds. Do not sell your stocks to avoid more losses. Do not stop buying more stocks because you're afraid they will lose value. Even hedge funds that have a lot of information to predict where the market will go still underperform the S&P 500. In 2021, hedge funds had a return of approximately 12%. The S&P 500 index has beaten the hedge funds for the past 24 years by over 200%. If you have conviction that the stocks will fall further and do not want to buy until they have reached the bottom, then listen to yourself and follow your own advice. Successfully timing the market is a losing game most of the time. How to come out ahead in this down market? Number one, increase your contributions to your retirement. You are getting the stocks at a cheaper price. An increase in contribution of even 1% of your pay will make a big difference in years to come. Remember not to exceed the annual contribution set by the IRS. Number two, open a brokerage account and start investing any additional money you might have. If you've had the privilege of speaking to someone who continued to invest during the 2008 market crash, you no doubt know that they've made a lot of money by continuing to buy stocks that people were selling cheaply out of fear. Number three, have your money in diversified funds if you have a low risk tolerance or are not familiar with the stock market. Growth stocks are the hype right now, but please do not invest in a company just because of hype. One company that I follow keenly is Tesla. If interested in the company, especially after watching the video I did on my channel regarding Tesla, it won't be a bad idea to buy some shares. Dollar cost averaging. Dollar cost averaging is a method of investment whereby you do not buy the stocks you want at once. If, for example, you have $10,000, you can choose to buy stocks worth $2,000 each day, week, or month so that you can take advantage of the stock's price going lower. Also, this applies to those who bought a stock at a higher price. You can continue to buy as the share price falls so that you can bring the average cost per share down. Many who see this down market as an opportunity will reach financial independence sooner than later. Stay tuned for my next video on the 7 rules of investing. Please remember to subscribe, like, and share. Thank you for watching. Until next time, bye-bye.